you are dry and safe and your home is good. And Hurricane Lee, well, it's post-tropical by the time it is hit this region. Whatever impact it is, hopefully you guys are safe with it, right? Obviously.
And I'm sure we'll have lots of listeners this weekend because I'm sure people will be tuned in and listening to all of the news. So if anybody has any feedback for us, feel free to reach out, whether that's an email or you send us a message on social media. We've been getting lots of messages lately, and some people thanking us just for some of the advice. We were talking about insurance, and we had a customer write us, or I guess a listener write us. I always say customers because that's my business, but a listener write us say, thank you. I talked to my insurance company. I've increased my insurance, so that's great feedback.
Yeah. And we talked quite a bit about insurance in the first segment of the show.
We love when we get that kind of feedback, and if there's something you specifically want us to talk about, you can certainly send us a little note.
Why is fall and spring? Those are the two big markets, eh?
Yeah, I think spring is definitely probably traditionally the biggest market. And then some people think like summer is dead, winter is dead. But fall, I honestly, is one of my favorite real estate markets. And I'm going to tell you why. Here's my little tip and trick. So, people who listen to the show, you're going to have a leg up on everybody else.
Okay.
People who have not sold their home from the spring going into the fall, and if they really want to sell their home, typically, they are more motivated to sell because they don't want to hold this piece of real estate through the winter. They don't want to pay for the heat. They don't want to pay for the maintenance. They don't want to pay the mortgage. They don't want to pay the property taxes. So I think vendors sometimes are a little bit more motivated when the fall happens. And the great time to shop for a new home in the fall means you'll probably get into this home before that holiday season.
Yeah, a lot of people, it'll be simply, I want to get moved before Christmas. It could be as simple as that.
It could be as simple as that, and we are right in the zone because when we do a mortgage approval, we are approving mortgages up to now, January 2024.
What are some of the rates you're guaranteeing right now?
Rates are all over the place, Todd. If you're doing a high ratio purchase, if it's a fixed rate, I know we talked about 5-year fixed, and we'll talk about what rate you shouldn't take later in the show.
Yeah.
But a 5-year fixed right now is somewhere around like 5.5%.
Yeah. And listen, that obviously seems high, and it is high relatively speaking, compared to what it was. But when you look at what happened with inflation in the 80s, and what the Bank of Canada had to do, interest rates were up 18-20% in some cases at that point, right?
Correct.
So I realized that the volumes of money borrowed was much less at that time. However, people's incomes were much less at that time.
It's
right. So it's all probably relative.
It's all relative, Todd.
Yeah.
People that went through that type of economic situation and that inflation, they were in certainly much more dire situations than we are in today.
Yeah.
We may feel that, hey, the sky is falling because our interest rates are 5 and 6%. But, overall, it's actually not bad. And that is the median mark on where rates normally are.
Yeah. So
they say the median mark is somewhere around that 5% range.
Right.
Like if we go back in history.
Yeah. Okay, so let me ask you this. With these rates, elevated interest rates, it's good for the banks, obviously, right?
It's good for
the lenders.
Yes and no.
If you're making more money on interest,
I think they're making more money, but their cost of funds is that much more.
What do you mean?
Because all the
they
banks,
got to borrow money.
They got to borrow money, and if you have money in the bank, guess what? You're getting more return on your investment than you normally do.
Yeah.
So yes, obviously having a higher cost of interest, but the cost of funds being higher, they're all working on margin, Todd.
Yeah.
They're all working on margin.
Yeah.
And it might seem, okay, the bank's making all this money because the interest rates are higher, but their cost of funds are higher too.
Right.
Relative, maybe as well. I think the banks make a lot of money no matter which bank it is. They all make a lot of money.
Yeah, like you said, the casino, right?
They're like the casino. The banks never lose.
Yeah.
And the federal government is actually putting in some legislation that's going to be impacting the banks, that they have to have more funds on deposit to lend out that much, which is going to increase their cost of funds even more, which might squeeze those mortgage rates even more.
When's that going to happen?
There's legislation that's changing. There's some that's going to probably be changing here, obviously, like in the fall before the end of the year. But the federal government is always looking through the Office of the Superintendent of Finance.
Yep.
Is always looking at making changes that are going to, protect Canadians really from themselves and protect the banks from borrowers. So they're always looking at different ways to like tweak and change things. And I remember, and I've been doing this for 17 years, there have been multiple policy changes that have impacted mortgage lending in 1 year. Multiple.
Give me some examples.
We used to do refinances up to 95%.
What's it now? It's 80, right?
80%.
80, yeah.
So you used to be able to get a high ratio refinance from a lender. Now it's all conventional.
Right.
We used to have amortizations up to 40 years.
40. Wow, I didn't know it was 40.
Yeah. And you used to be able to buy a home with zero down.
Zero down.
40-year amortizations.
And you can see
if you had a heartbeat, we were giving you a mortgage.
And you can see how that could be problematic when it comes to
100%. I can see how that could be problematic
because the risk factors, the risk tolerance here, right?
And
obviously.
People were getting homes with literally like no skin in the game.
Right. Can you still borrow? Because you hear other commercials, other lenders other than yourself, who we shall not mention, say that you can borrow the down payment from them. Can you do that?
Yes, we do borrow down all the time, Todd.
Yes.
So Nova Scotia has a borrow down payment program, which is amazing. They allow a household income over $100,000 to buy a home.
Right.
I think it's 140 or 150.
So that's no skin in the game then if you're coming in that situation.
Well, you still have to have the money for the closing costs, and you need to be approved for the mortgage, and you need to be approved for the Nova Scotia Down Payment Assistance Program, and you have to pay the loan back over 10 years as interest free.
Oh, is that right?
But if they give you 10 years,
so that loan is not rolled into the mortgage?
Separate payment. Everything's separate.
Interesting. Didn't know that.
So it's basically a second mortgage.
Yeah,
and you pay a higher insurance cost to the Canadian Mortgage Housing Corporation, Sage, and our Canada Guarantee, because technically it's a borrowed down payment. So you can do that. The other type of borrowed down payment we do is, and if you're actually borrowing it from like a line of credit or a loan or a credit card or something like that, you can do a borrowed down payment. Yeah. And it's the same insurance cost if you do the Nova Scotia Down Payment Assistance Program or if you do the borrowed down.
Okay, so what's the interest on the down payment? Do you know? Would it vary? I suppose it would.
It depends. If you're borrowing it yourself, it would be whatever the credit facility is. If you borrow it from the Nova Scotia Down Payment Assistance Program, it is an ostrich egg. Zero.
All right, so obviously the best case scenario is you're walking in there and you get 20% of your own money to lay down on the table. That's
if you do 20% down, you can do an extended amortization. Like you can do 30 years.
Yeah.
Plus, you could have access to like alternative lending sources. Yes. Like if you need to do a stated income deal, or if you've had any credit issues or stuff like that. If you do 20% down, it opens up a lot more doors, and you don't need the concurrence from the Canadian Mortgage Housing Corporation, Sage, and or Canada Guarantee. There's 3 insurers in Canada.
Yeah. How often are you seeing 20% down?
The bulk of the transactions we're doing are currently conventional with 20% down or more.
Really, eh?
The bulk.
Yeah. I've never paid 20. I've always paid 5. Obviously because I've not had enough money to pay 20 over the years,
but you know what? That's been okay. It's worked out for you.
It's worked out, yeah.
You've also bought real estate, improved it, and then it's been worth more money.
No, absolutely.
So everybody's situation is different, but I think that brings up a really good point, Todd. You've owned multiple homes.
Yep.
But you've also bought homes even recently and put down only 5% down.
Yeah.
So that's a misconception. People think you can only put down 5% on your first home.
Right.
If it's owner-occupied, you can put 5% down forever.
Forever, yeah. If it's not
if it makes sense.
If it's not owner-occupied, then you need 20%.
20%.
Yeah.
Or, I mean, if it's a rental, you need 20% down. But if it's not owner-occupied, like, let's say it's a second home or you're buying a home for your kid or a family member to live in, you can still get a high ratio mortgage.
Can you go 5-year, 30-year? No.
25 years.
Is that it?
On a high ratio, 25 years is the max.
Right. So obviously if people want to get into the larger home or whatever and they have the 20% and they amortize it out over 30 years, that's the ideal scenario for somebody if their income might not be quite what it like as to get into something that they want. That's an option, right?
That's basically what I did for myself.
Is that right? Yeah.
I did a 30-year amortization.
Yeah.
You know what? For me, I would always try to do a 25-year because the 25-year has a lower interest rate. The reason I did a 30 for myself, and I'm going to be completely honest, I'll talk about my own personal finances. The reason I did 30 was because I'm self-employed, and who knows? I didn't know what the future was going to bring. But as soon as I funded that mortgage, I did a payment increase, and I brought it up to 20 years, made payments, had it down to about 18 years. And then obviously with the interest rates going up, the amortization's longer now.
Yeah.
But I did have the intention on paying it down faster. And I pay down a bulk of the principal in the last couple of years that I've had the mortgage. I paid down thousands of dollars.
Accelerated biweekly payments, that makes a difference
Yeah,
too,
I think
right?
accelerated certainly makes a difference. If you're paid biweekly, do a biweekly payment, whether it's accelerated or regular. I always recommend people matching up their mortgage payment with their payroll. It's painless.
Yeah.
I do weekly because I pay myself weekly.
Right.
No pain. I put my pay goes in my account Monday morning, and guess what? Monday night, my mortgage payment comes out.
All right, so everybody's waiting to know the rate not to take. We're going to get to that next.
The rate not to take. Stay tuned.
Mortgage 101, your guide to homeownership.
If you've liked what you've heard and you want to learn more, feel free to visit us online at teamclinton.ca.